Today we're talking about low risk yield farming. It doesn't matter whether it's on Polygon, Binance Smart Chain, Ethereum, Solana. It doesn't matter what blockchain it's on. We're going to be talking about what are low risk strategies. We're going to talk about 4 different types of risks that you need to be aware of. People love to yield farm because they love to earn passive income. And ladies and gentlemen, if you're familiar with my channel, you know that I love cryptocurrency and I love passive income. And if you like cryptocurrency and you love passive income, do me a favor and smash that like button. I believe that decentralized cryptocurrency is extraordinary technology that's going to change the world. And I feel honored to be born in this time, to be able to interact with this technology. And hopefully you feel the same as well. Let's get started. So there's 4 main risks you need to be aware of. The first risk, we'll start right here with the page that I'm on, and that is what I say is blockchain risk or network risk. I'm talking about specifically the foundational blockchain that the yield farming is taking place on. So whether that's Ethereum or whether it's Binance Smart Chain or whether it's the Polygon network. There are certain risks that you want to be aware of. There's fees on each network. Ethereum fees are far higher than, say, Binance Smart Chain. But Binance Smart Chain, their fees are substantially higher than the Polygon network, for example. You also want to look at the amount of volume that's on the exchange. So Ethereum probably has the most volume of these 3 blockchains in particular. Binance probably has the next most, and then Polygon probably has the next most. Although Polygon's catching up very, very quickly. There's other blockchains out there. There's Solana. There's Harmony One. There's several blockchains out there. They don't have as much volume. They maybe have cheaper transactions. They're newer technologies. You just want to be aware that the risk really does begin with the blockchain that the decentralized farm is built on top of. And that is a risk that you have to be aware of. Now we're going to talk about how to mitigate all these risks, but I want to go through each of the risks first. And just so you know, we're going to cover 4 risks, how to mitigate the 4 risk or how to make the lower risk decision. And then we're going to look at what is like the safest possible strategy. Then I'm going to share with you my strategy where I weigh risk with reward and make a decision based on the balance between risk and reward. Not financial advice for you. I'm just sharing you my thoughts, what I would do. And then I'm actually going to demonstrate how to actually go into one of these farms. And I'm going to also demonstrate how to come out of the farm. A lot of people say, well, if I want to get out, how do I get out? So I'm going to show you all of that in this video. So we've covered network risk. The second risk that you need to be aware of is going to be smart contract risk. So all of these blockchains, Ethereum, Binance, Polygon, they all run basically software programs, what you would think of as a software program. So if Windows is an operating system and you have, you download a software onto your Windows computer, the best way to think about it is blockchain is like the operating system. It's a decentralized operating system. And there's software programs, even games, for example, that run on top of those systems. Of course, it's all very decentralized and it's totally different technology. But if you're not familiar with cryptocurrency, I just want you to have an idea what's taking place. So there's always going to be a smart contract risk. So for example, let's just come over here to like the Aave network. There's $16 billion sitting on this application, by the way, but Aave is essentially a complex smart contract. There's always a possibility that, just like there's bugs in software, there could be a bug. It's good to look for projects that have been audited, but even an auditor can miss a smart contract bug, for lack of better terms. I mean, you just need to know that no matter what, there's always going to be some smart contract risk. And there's even ways that the contract may not have a bug in it, but it can be exploited. There's something called flash loans, and there's a project on Binance Smart Chain called Venus that would be considered typically a pretty safe project. It had a lot of money in it, similar to what you just saw there with Aave. Had millions, probably billions of dollars in it, and it ended up getting exploited. Someone did something called a flash loan, and they attacked it in a way that no one was really aware could happen. So there's always that sort of risk that can take place. So there's network risk or smart contract risk. Let's talk about token risk. So when it comes to token risk, you got to look at like what are you investing in? You got DAI, USDC, USDT, Wrapped ETH, WBC, Aave over here. You can come over to something like QuickSwap, and you can see they got Link, Ethereum, Aave, Ethereum, DAI, USDC, Titan, Matic. There's all these different tokens that you can invest in and provide liquidity for. Now, I'm assuming you know how to yield farm. I'm assuming you understand what it is. If you don't, I do have a video series that teaches exactly what yield farming is, discusses things like impermanent loss. I'll link that above over here at the top, and I'll put it down in the description so you can be sure to check that out. But anytime you're providing liquidity, the underlying asset is important. If that underlying asset is going to be very volatile, then you've got a tremendous risk. You are always susceptible to the price movements of the underlying assets. I get a lot of questions, and if you have this question, then you need to go watch my playlist. I get a lot of questions. If I put in, 100 of this token and 100 of this token for a total of 200, if I withdraw, don't I still get my 100 tokens each out? Most of the time, the answer to that question is no, absolutely not. And if you don't know why you're not getting exactly 50-50 back, you need to go watch my video on how to yield farm, because you're missing some of the basics, and you absolutely should not get into this space yet because you're missing the most basic concepts of what liquidity pools are. Token risk is really the biggest risk. Crypto is volatile, so all these tokens move. So that's important for you to be aware of. The fourth risk you want to be aware of is developer risk. Developer risk is things like, do they have a track record? Is it one developer? Is it a team of developers? How long have they been in this space? You want to be aware of the developers in general and what kind of project they're working on. There's a lot of projects that are like one-man army. So I'll show you a high-risk project. Polywell. The developers just quit yesterday. They just quit. This token, at one point in time, this token was over $100 per token. Today it's 12 cents. For a lot of reasons, the tokenomics are really bad anyway. But the developer, look, there's no announcements listed. They're like, yeah, we're just tired of the project. Yeah, we got mental health issues. Yeah, we got whatever. And I mean, maybe they do got mental health issues. That's not the point. The point is that is a risk to your investment. You put money in this thing and it just poof, disappears because the developers just, drop it. Forget about it. Now, a mature decentralized project, in theory, you would like to think that developers could walk away and it would run. But a lot of these farms, not only is there smart contract risk, but there's always going to be some developer risk. Now, something like Ethereum, you're not going to have, developer risk so much. Vitalik Buterin is the main developer. He's essentially the CEO of the Ethereum Foundation. If Vitalik kicked the bucket or got hit by a bus, God forbid, development would continue with Ethereum. I mean, there's probably hundreds of Ethereum developers. There's probably a bunch of different developers for Binance Smart Chain and Polygon as well. So you're going to have less risk to development there. But when you start getting to projects like SushiSwap, which are kind of like second layer projects, QuickSwap, these all run. QuickSwap runs on top of Polygon. SushiSwap runs on top of Polygon and Binance Smart Chain. So these are exchanges. These are apps. These are smart contracts that run on top of the previous network. And then when you look at things like Polywell or even Adamant.finance, these are projects that really complement the QuickSwap and the SushiSwap type ecosystem, but there's even more development risk there as well. How many developers are behind the scenes? Do they have a track record at all? And if they're anonymous, that's okay as well. But you just got to recognize that you have a risk with developers. And the further you get away from the network, the more risk you have. I would say that being on Polygon, for various reasons, could be considered a little bit more risky. Not considering fees, but it could be a little bit more risky than, say, Ethereum. But when you start going to Aave's built on top of Polygon. It has a great reputation. It utilizes the Polygon and Binance Smart Chain and Ethereum, I believe. But technically, doing anything on Aave is going to put you at greater risk than holding tokens on Matic, for example. When you start coming over here to QuickSwap, let's just stay on the Polygon network for now, and it could be on any network. But you come over here to QuickSwap or SushiSwap, now you're talking about, a smaller project getting, a degree or so away from Aave. And if Aave is a degree away or so from Polygon, now you're talking about taking on a little bit more risk. If you go to something like Adamant has all of these. It has SushiSwap, it has QuickSwap, and all these other swaps that you may not even be aware of. ApeSwap is another one I've talked about before, but it's an aggregator. So there's an additional smart contract in place to take care of this. Is additional tokenomics with the Adamant token. So it would probably be more risky than even QuickSwap or SushiSwap or ApeSwap, which I don't have up here listed. It's going to be more risky than, say, Aave. And of course, it's more risky than just holding Matic on the Polygon network in your wallet. So the further you get away from the network, I would say you're taking on another layer of risk. The more you're needing to rely on smart contracts, you're taking on another layer of risk. Developer risk really applies to everything, because when you're in Aave, right, you're taking developer risk on Adamant. There's developers developing on this. There's also smart contract risk here. And then you're using one of these exchanges. You're providing liquidity for one of these exchanges. So let's just say QuickSwap. That's developer risk. Adamant can't function if QuickSwap smart contracts aren't functioning properly. If QuickSwap gets exploited, that's probably going to affect your pools on Adamant as well. It's going to affect your earnings in the Adamant token or any rewards you get for the Adamant token. So there's additional risk there. If there's Matic issues, I dealt with that the other day. There's Matic issues for whatever reason. The Matic network gets really congested. You can't get, you got a farm you're trying to pull out of. You got prices going down on assets in that farm, and you can't get out of the farm because there's an issue with the Matic network. And by the way, all blockchains are subject to congestion. But the other day I dealt with that for the very first time on the Polygon network. That's a risk that you have to be aware of. So we're talking about network risk, smart contract risk, token risk, the underlying token risk, and we're talking about developer risk. So if you want to say, okay, how do I mitigate this? What's the safest strategy? You want to get as close to the Polygon network as you can on the project that has the most proven development with the best possible track record of developers. So in my opinion, it's just my opinion, you would look at something like Aave. Now the challenge is anytime you decrease risk to the absolute maximum, then you're still going to decrease potential profits. And if you come into Aave, for example, you can see that the returns are quite low. Aave was super popular a couple months ago because the returns seem really high, but that's just because the Polygon network was running a promotion. And you know what's funny about that is a lot of people didn't know that it was a short-term promotion. When it comes to limiting token risk, let me just mention this. You want to use something like stable coins. Now there is a stable coin risk, and I can make a whole video on that. In the world of crypto, it's probably a lot lower, 99.99999% of the time. Anytime that you're yield farming, you're providing liquidity, you're allowing assets, you're staking your assets on a platform. You prefer not to see a lot of price movement unless the price goes up. But you don't want to see your assets move a lot in price because that can increase the risk of loss, losing USD value of those assets. It also increases on the farms. Aave is not a farm, it's a borrowing and lending platform, which works a little bit different. But they still pay a yield. The yield is just quite low. But you're going to see single token assets. You could use a stable coin. I would recommend a stable coin. You're going to earn, 1.3% plus 3%. So you're looking at about 4% a year, 5% a year for DAI. USDC is going to be paying about 2 to 3% a year. And this is that promotional amount of Polygon or Matic I was telling you about. You'll hear me use Polygon and Matic interchangeable, and I apologize for that. I just have a habit of doing it. So you're looking at the most you can get here is probably about 5% a year. Now, ladies and gentlemen, this would be one of the lower risk ways to yield farm. I wouldn't do it. I'm not going to stake none of my crypto on a platform to make 4 or 5% a year. Now, this is a lending platform, so sometimes people like to put in their crypto and withdraw 50%, 70%. I don't care about that. You will not catch me doing that. Some place like crypto, in my personal opinion, taking on smart contract risk, even some stablecoin risk, which I didn't even hit on here. And I'm just not going to stake my tokens for only 5% for the year. No, thank you. I would go into certain masternodes first. I'm going to be doing a future video on a masternode that's paying about 20% a year. I would much rather do something like that. And if you want to see that video, make certain you subscribe to the channel. Click that bell notification icon and click all. Would be one of the safest things you could do. The next thing you could do would be something like provide liquidity on something like QuickSwap or SushiSwap. And you can see their numbers, this is saying Ethmatic, but let's go to stable coins. Because if you're going to do lower risk, you always want to do something like stable coin. USDC, USDT is what they got. They're paying out 15% a year. That's better than 5%. You're taking on a little bit more risk on the QuickSwap platform. I would say the actual smart contract risk is higher, but I would rather do this personally and earn 15% APY than 5%. But I'm probably not going to do it for 15%, to be very honest with you. But this would be the next option. And I'm going to share with you my strategy, and I'm going to actually go into the farm, deposit onto the farm, and I'm going to withdraw out of the farm and just kind of show you how that works. I'm going to use something like the Adamant network. Adamant.finance is an aggregator. So I'm going to provide liquidity. And I've got increased smart contract risk, right? I've already talked about that. So I've got smart contract risk with the Adamant platform and this aggregator. I got smart contract risk with whichever farm I'm providing liquidity for. And of course, I've got network risk. I've also got developer risk from the Adamant Finance. Now, Adamant's been around for about a month or so. Developers tend to be responsive. It doesn't mean anything, but you like to see that. They have had one audit. There's an CERTIC audit getting completed soon. We'll see how that turns out. By the way, audits don't guarantee anything. It just makes you feel better, and it means that the audit didn't find anything that should be exploitable. So it's basically a double check, a second check, or triple check. So it's good to see audits. But just because you see an audit does not guarantee safety. It may decrease risk. We're all about decreasing risk, but it doesn't guarantee safety. So keep that in mind. If you're looking for guaranteed safety, you should not be in crypto. Let's look at stable coins. That's what we want to look at. So something like USDC, USDT. And here's what I would do. I would come over here and I would sort by APY, and I would get the highest paying stable coin I could get. That's the lowest APY. So let's hit it again. So these are not stable coins. So we'll go down till we get stable coins. Just 2 stable coins, because then we're going to not have any token risk. Token risk is where you can lose the most money, and it's where most people lose. It's not smart contract risk. It's not It's not network risk. Most of the time, token risk is where people lose. So get down to here. We're not going to have anything at 1,000% for for stable coins. So here's one. We got DAI and USDC in the vault. Now, I'm not familiar with this vault project very much, so I'm not going to use that one. I'm more familiar with QuickSwap or SushiSwap, so I would use one of those. Again, here's vault. And it's not a huge difference, but I think I'll come down here and I will use USDT DAI. For me personally, I would probably come in, depending on how much I had, I would come into both of these. But for this video, I'm just going to do one. I'll come in here. I need to add liquidity. Now I'm actually going to come over to swap first because I have USDC. And I'm going to put that into USDT. And so I'll just move over 9,000 just to keep the numbers round. I'm paying $27 in fees just to show you all this. So come on, that deserves a like. Let's do it. Good enough. 27.15. We'll get the transaction to go through. So now what we're doing is we're adding liquidity, and keep in mind we're going to go into the USDT DAI pool. So I need 50% USDT, 50% DAI. And I'm assuming, again, you understand what yield farming is. If not, go watch the playlist down in the description. So that's saying that went through. Let's hit refresh. Sometimes it just is a little bit of a lag. We got it right there, USDT. So now we got USDT. And we need to get DAI. We'll split it in half. Normally I'd break out the calculator, but that would be 45.14. I think that's right. Approve. So we're still swapping. We need to get our stacks half and half. So we've got USDT. We're swapping half of it for DAI. So we have roughly 50% USDT, 50% DAI. That transaction has went through. Is still showing pending, but it's obviously already went through and it's not reflected on the website. But there we go. It just got reflected. Now what we want to do is go to the pools. And you can create a pair, add liquidity. You want to click add liquidity. In this case, we're going to choose DAI. And we're going to choose USDT. And it doesn't matter if you say USDT or DAI, it's irrelevant. And then what I do is I click max on one of them. When you do that, it's like, oh, I must have more USDT value than I have available in DAI because it's not showing, this button didn't light up. So just click the other one. Yep, there we go, supply. So it's pretty easy to see which number is bigger when you're doing stable coins. Obviously this number was bigger, but that's not always apparent if you're trading other assets. But then click supply, confirm supply, confirm. All right, transaction confirmed. So we should be able to come back over here to Adamant, and you can see that we have some tokens here. Whenever you use stablecoin tokens, you're always going to see some decimal usually. You just click stake. You might have to approve the token like this. Click approve. Confirm. Wait for that transaction to go through. And just so you know, it can take several minutes for a transaction to go through. 2, 3, 4 minutes on Polygon. If you were using Ethereum, it can take 5 or 10 minutes or more. There we go. Transaction went through. So it should say, there we go, all tokens. Click confirm. And now we should see those tokens show up over here, and it should show us a USD value right here. There we go. Let's click close. It'll take a minute to reflect on the website. There it is. There we are, just under $9,000 sitting here. Now on this particular platform, I'm going to get rewards. By the way, I did a video breaking down Adamant.finance early on when the platform was a lot newer. I'll link that video above. I'll put it down in the description. You can watch it because there's some interesting aspects to the Adamant token. Now, just so you know, I would never buy the Adamant token at this point. Show only stake. This shows you what you're in. So here's my pool. So I would never buy the Adamant token at this point. You got to know that. You do earn some free Adamant tokens, and I explain how that works. I currently have the Addy token, and for my Addy token holdings, literally I'm getting about 1% worth in Matic every single day. Plus I'm getting some Addy rewards. So to understand all this part, this is outside the scope of this video. It adds some safety only in the fact of you can sell your Addy rewards if you want, and that helps you either add more to the pool. It helps you withdraw some of your profits, that sort of thing. So right now I'm going to be earning 73% APY at this very moment across all mechanisms. The quick token compounding. So with this, just so you understand, this is an aggregator. It's compounding my LP token. So these tokens will increase over time. And what it does, it takes the rewards. You can read it right there, 4.42% auto compound quick. It takes the quick rewards for providing liquidity on quick. I earn quick rewards. The farm is actually on quick. You saw me put liquidity on quick. So I earn those quick rewards. Instead of just keeping those rewards or collecting them, what this platform does is it cashes those rewards in. It buys more USDT. It buys more DAI. So it increases my return. So I'm not earning 15%. I end up earning about 73%. Plus I earn some of these added rewards as well. And if I choose to, I could come in here and sell those periodically, or I could stake them if you understand how those tokenomics work. So for me, I'm going to do something like this. When I look at something that's lower risk, I'm going to minimize my token risk by using stable coins. I'm also going to minimize my developer risk by using a project that I at least feel like I can trust a development team. I'm not worried about this token price. I think this token price ultimately over time will go down. It may go down slowly, and I could be wrong, but I think ultimately over time it's going to go down. There's a lot of incentives for people to hold the token. That's why I hold quite a few of them. But over time, I think it goes down. By the way, this number here is for people who hold the Addy token. So there's no way to go into this unless you actually buy the Addy token. You may earn Addy tokens, but if you're doing something that's lower risk, I would never buy the native token of the platform ever. And I would only, if you're trying to do something low risk, only go into dual stable coins, DAI, USDT, USDT, USDC, that sort of thing. And if you're super risk adverse, you could always go into Aave, but you're making 5%. That's just not enough for me. Like, it's not enough for me to do anything. I'll just hold it in my wallet for 5% a year. Now, in this case, I'm going to show you how to remove this. Click on here, come over here, click claim, vest, and exit. Typically, you'll see something like exit, because I gotta do two things. I gotta get out of this pool. I gotta get my LP tokens back. I gotta go to QuickSwap, and I've got to convert or break my LP tokens and get back USDT and DAI. So exit, confirm. Now I'm getting my LP tokens. One way to think about an LP token is this, like a claim receipt. If I came over here now and look for my liquidity, let me just show, I already got it. I want to show you something real quick because people don't understand this. I'm actually going to go back into that pool. So right here, I'm in USDT DAI. I want to show you this real quick. By the way, I had to pay 5% for getting out early. That's part of the tokenomics over here. If you get out within 72 hours, you pay 5%. So I'm telling you, this video is costing me quickly. But I want to show you, like, if I come over here to if I wanted to come out of liquidity, I would have to come to liquidity pool, and it says no liquidity found, meaning right now QuickSwap is looking at my wallet and says, hey, you don't have any liquidity tokens. And they're right, I don't, because my liquidity tokens, my claim check, my receipt to prove to QuickSwap that I have liquidity in their pool is not in my wallet. It's over here in the Adamant platform. So I have to retrieve my claim check or my LP tokens for QuickSwap to recognize that I have liquidity over here. So watch this. Now we'll remove. Probably pay 5% fee again. When this transaction goes through, these liquidity tokens are going to move over here. Transaction confirmed. And liquidity's gone. It's still there, by the way. You just can't see it. If you come to QuickSwap, it's not staked. It's still there. Go to USDT. Here's that same liquidity pool. Here's my tokens. They're not staked on the platform. But watch this. Now I can go to QuickSwap. I can refresh. And it's probably going to see my tokens. because I have my claim check in my wallet now, and it's going to detect that. There it is. So now, because I pulled my LP tokens off the platform, they're sitting next to my wallet. They're in my wallet. Now manage, and I want to remove the LP tokens. So remove, and what this will essentially do is break my LP token into DAI and USDT. This is the amount of USDT I have. This is the amount of DAI that I have. Click max. This is what I'm going to get back. Click approve. Sign. Remove. Confirm. That transaction will go through, and I should have, there we go. And now if we go back to my wallet, I should have DAI, and I should have USDT in my wallet. One way you can see that easily is come to swap. Just go back and put DAI in. There it is. We can see DAI right there. We can see the USDT as well right there. So there we go. If I wanted to, I could swap all that back to DAI. By the way, DAI is one of my more favorite stable coins, just because it's a little more decentralized. Today we discussed what are some of the risks to yield farming and how to mitigate some of those risks. I talked about the safest strategy would be to go to some platform like Aave. Another one could be Curve, which we haven't talked about today. And you would just stake on those platforms. Place your collateral on those platforms. You're going to make, a lower percentage. You could always go to something like QuickSwap, SushiSwap, make a little higher percentage. You could go to a compound aggregator like Adamant and make a higher percentage. But each time you go from Aave to QuickSwap, Aave and Curve would probably be considered safer. Less development risk, less platform risk. Then you go to QuickSwap and Sushi, you're going to be a little more higher risk. Adamant would be the most risk. And then using stable coins is going to limit some of your risk. So for me, I like using Adamant. I want to know that I'm going to make 40, 50, 60% on my stable coins if possible. Of course, in this particular one, I was making 70-something% APY. I like that personally. Using stable coins limit your risk. Always use stable coins. And I didn't cover this, but even single token coins are going to be good to use. But understand, what can happen on these platforms? People are like, what's platform risk? What platform risk? Well, it's possible the website can go down, but that's not necessarily a big a deal because sometimes you can interact with the smart contract itself. But if you can't get your funds off, or if there's a way for the developer to siphon funds off of a website or a platform, that's a big deal. So I showed you the safe strategy, stable coins on something like Aave. My strategy is stable coins on some compounder such as Adamant. None of this is considered financial advice. These are much lower risk strategies. If you love earning passive income, go down into the description, subscribe to our Crypto Passive Profits newsletter. Thank you so much for watching, ladies and gentlemen. I have a video coming up next where I'm going to be talking about some of the latest news about what's been going on with the crypto markets, why they've been pulling back, what my thoughts are, where I think they're going in the future. You're not going to want to miss that. I love talking about news. I love talking about passive income projects. Ultimately, I just love cryptocurrency. Decentralized cryptocurrency equals freedom. This is Crypto Wealth. I'm out.